Welcome, everyone, to this eye-opening discussion on financial loopholes you didn't know existed. Today, we'll explore some legal, albeit lesser-known ways people navigate the financial system to their advantage. Let's get started. Before diving in, it's important to understand what a financial loophole is. A financial loophole is a technicality that allows an individual or company to avoid the scope of a law or restriction without directly violating that law. Let's look at some intriguing examples. Many people are familiar with Roth IRAs, a powerful tool for tax-free growth. However, income limitations can be a roadblock. This is where the backdoor Roth IRA comes into play. Let's break it down. First, contribute to a traditional IRA. There are no income limits for making non-deductible contributions. Then, convert the traditional IRA into a Roth IRA. You'll pay taxes on the earnings, if any, but not on the contributions since they were non-deductible. Now you've got funds in a Roth IRA that will grow tax-free and can be withdrawn tax-free in retirement. Remember, timing and existing IRAs can complicate things. Always consult a tax advisor before executing this maneuver. The 1031 exchange is like a magic wand for real estate investors. Imagine selling a property, and instead of paying taxes, you reinvest those gains into another property. Here's how it works. First, identification. After selling a property, you have 45 days to identify up to 3 replacement properties. Second, purchase. You must complete the purchase of one or more of the identified properties within 180 days. Third, intermediary. An important catch is that you can't touch the money in between. It needs to be held by a qualified intermediary. Finally, tax deferral. By doing this, you defer all capital gains and depreciation recapture taxes, allowing you to grow your real estate portfolio more quickly. Next are the family gifting loopholes. Want to pass down assets without the tax burden? Through gift splitting, spouses can double the annual gift tax exclusion amount for a recipient, effectively transferring wealth without triggering taxes. Hedge fund reinsurance in Bermuda. High net worth individuals and hedge funds often use Bermuda-based reinsurance companies to sidestep taxes on investment income. Money invested in these companies can grow tax-free, as long as it's classified as insurance reserves. Delaware holding companies. Companies incorporate in Delaware, not for the beaches, but for the tax advantages. By placing intangible assets like intellectual property into a Delaware holding company, businesses can cut down their state tax bills. Inversions. Inversions are when U.S. companies acquire smaller foreign businesses and then switch their headquarters to that lower tax jurisdiction. Though controversial, they're a way to significantly reduce a corporation's tax bill. Zero-coupon bonds. By purchasing zero-coupon bonds, you're essentially buying a bond at a discount. You won't receive interest payments, but will instead get a lump sum at maturity. This allows you to defer taxes until the bond matures. Wash sales. Wash sales involve selling a security at a loss and then buying it back shortly thereafter. This can help to offset other capital gains, although there are limitations and rules to observe. SEP IRAs for business owners. SEP IRAs are the unsung heroes for freelancers and small business owners. They offer a high contribution limit up to 25% of your income or $61,000 for 2023, whichever is less. Here's why it's valuable. First, tax deferral. Contributions are tax deductible, providing immediate tax benefits. Second, flexibility. Unlike 401(k)s, SEP IRAs do not require you to contribute every year, giving you financial flexibility. Third, simplicity. These accounts are easier and cheaper to set up than other types of retirement accounts tailored for businesses. Finally, investment control. Like a traditional IRA, you control how the funds are invested, offering a wide range of investment options. The catch: if you have employees, you have to contribute for them as well, based on the same percentage of income as for yourself. Next is using trusts for tax benefits. Irrevocable trusts can be a robust tool for estate planning. They can remove assets from your estate, reducing estate taxes, while allowing the assets to grow tax-free. Private foundation donations. Private foundations can act as a reservoir for your charitable giving. Money contributed is tax-deductible, and you retain control of the assets and how they're distributed to charities. Finally, stock donations. Donating stock instead of cash can be beneficial. If you donate stock that has appreciated in value, you can avoid paying the capital gains tax and still get a tax deduction for the full fair market value. That wraps up our deep dive into financial loopholes. If you found this information valuable, do me a favor, hit that subscribe button below and ring the notification bell. That way, you'll never miss out on actionable insights that could change your financial landscape. Got questions or topics you'd like us to cover? Leave them in the comments below.